Welcome to Wealth Matters Podcast. I have with me Dmitriy Fomichenko. He's the founder and president of Sense Financial Services LLC, a boutique financial firm specializing in self-directed retirement accounts with checkbook control. He began his career in financial planning and real estate investing in 2000. Welcome, Dmitry.
Thank you. It's great to be here.
How are you today?
I'm doing great. Besides the fires that is burning, we just had a quick chat about that. It's pretty bad, but other than that, doing great.
Yeah, so I just want to remind listeners that I am in San Francisco Bay Area and Dmitry is in Orange County, which is Southern California. And pretty much entire California is seeing wildfires. And as of now, as of today, 3 million acres have burned. So it's bad. So praying for, the fire to stop, praying for that, not many people and the wildlife will lose their lives.
We need some rain.
Yeah, we need some rain and then let the mudslides begin, right?
Yeah.
So that's the problem. But yeah. So tell us something interesting about yourself.
Well, all persons you can hear, and as your listeners probably can hear, English is not a first language for me, just like it isn't for you.
Exactly.
I am an immigrant. I moved in this beautiful country back in 1996 from Russia. I met my beautiful wife here. We actually met at the small Russian community church.
Wow.
And but I have been here more than half of my life now. It is my home. It is my country. I didn't even keep my Russian citizenship. I'm a citizen of this beautiful country. And I'm one of the 9 children. So I was born in a large family, and all boys, 9 boys. So can you imagine my mom raising us and my dad trying to provide for us. So it's been tough. That's actually one of the reasons we moved in. But the main reason we moved in this country back from former Soviet Union is because of the religious persecution. I grew up in a Christian home, and my grandfather actually was imprisoned because of his faith, and my father was kicked out of the medical school. And so we moved here for freedoms, religious freedoms specifically. And just it's kind of sad to see things changing so much in the last 20 years and those freedoms being taken away.
And it's happening everywhere, right? All around the world now, China, all over.
But, there is nothing like the United States. It's the best country out there. And just a reminder to listeners, treasure what we have here. It's very unique. There is nothing else like this out there. So make sure to protect our freedoms.
Yes, no, I totally agree. And I'm an immigrant. I immigrated in early 2001. So I can relate to all of this, right? Not I can relate to the religious persecution, but, U.S. is an amazing country. We got religious, we got all kind of freedom. And sometimes when people, discuss about, I can't go out because of coronavirus, I'm like, this is a, first world problem. People are dying because of bombing and religious persecution and whatnot in other parts of the country. And we don't realize or treasure what we have, right? And we complain about, I can't go out today, tomorrow, there is fire. Because of that, I can't run outside. These are all first world problems, right?
Yeah.
But yeah, let's get back to what we need to discuss. How and when did you start in real estate?
Well, it's been an interesting journey for me. I was introduced to the concept of real estate investing probably somewhere in 2000. Yeah, okay. Probably around year 2000. I had a friend at college who actually introduced me to the concept and invited me to one of the local real estate investment clubs. So I've been attending for about a year or two, and in 2001 I purchased my first property, which was actually my residence. That's the year I got married. So a few months before getting married, purchased a condo here in Southern California. And then about a year later, in 2002, I purchased first investment property. It was a hard foreclosure in Inland Empire. And those two properties served as a foundation for me or for my investment career. It was a good time in 2001, 2002.
Oh, yes.
Market was rising at the time.
Yeah.
Both of my properties, believe it or not, in about 4 years, they almost tripled in value.
Yes. Yeah. Well, I believe you. Yeah. Because
So,
2001 was almost at bottom because of all the, .com crash and whatnot, and it was rising. And then 05 and 6 was the peak of the market, right?
Yeah. So those two properties, I actually did a cash out refinance, pulled the equity out, and I started buying more properties out of state.
Nice.
And now I started buying properties, and then let's see, that was a year, I think 2005. I actually went full-time in real estate, working with the local real estate investment firm. And so basically a transition full-time. And then a few years later, because of all the market changes in 2007 and
yes,
the crash that began, we've seen that most of investors that we've been working with, they could not continue buying with their personal names because they had
they had foreclosed, short sale,
or short sales. Yeah, market. That happened to myself also. A few properties I ended up losing.
Oh, wow.
Anyway, so we've seen that people had money in retirement accounts, and we've worked with few self-directed companies. None of them actually worked out, and because of my past experience being in financial services, that's what I did before coming full-time in real estate. I was given a task to start a department within a company to do self-directed IRAs. So I did that in 2009 for about a year, and then in 2010 I transitioned on my own and I started Sense Financial, which is we specialize in creating self-directed retirement accounts with checkbook control. So I invest using my self-directed retirement account. So I practice what I preach, and that's what we do. We help clients do that. But that's kind of the evolution of my real estate investment career.
Okay. And we'll get to that STIRA or self-directed IRA piece as well. One of the question I have that you mentioned you started buying out of state. Can you elaborate why? What was the motivation or what was the reason?
Well, the reason was because of the affordability. It was difficult to afford something in Southern California when the prices were, like I said, two of my properties, which I ended up buying well at the good time, they almost tripled in value. I mean, imagine just a few years later, trying to buy something that is now worth 3 times as much.
Yeah, and the rent hasn't gone up 3 times.
Exactly,
right?
that's for sure. So there wasn't any cash flow here.
Yeah. So, and the reason I asked you to go back was that I want to remind listeners that, I focus on cash flow investing. I started investing about 10, 11 years after Dmitry, but followed the same path, invested in 2011 here in California. But starting 2015, I started only buying out of state. I don't have any investment whatsoever here in California, just because I think it's all speculative. And I want to make sure I have positive cash flow, right? So Dmitry was far ahead in this game because he learned that 10 years ago. Right now, people are still trying to figure out if they can invest in California or in West Coast markets. But Dmitry had done that, in 2005 and 6 when he, saw that it's not affordable to buy in, California itself. So, do you right now? Where do you invest, or what kind of assets?
Yeah, so over the years, again, like I said, I started with 2 properties and then I transitioned. I actually end up, there was a transition period for me. I did a few fixer-uppers and I did a couple of multifamily, small multifamily. I had 3 fourplexes in Alabama. So I did a lot of hands-on. In addition to buying new construction, I did some fixer-uppers as well. And it's been taking a lot of time. So when I
Yes.
started my business, I didn't have any time nor desire to be hands-on. So basically, I made a shift. I liquidated most of my portfolio. I had over 20 properties at one
Oh, wow.
time.
Okay.
I liquidated most of my portfolio, and I basically started private lending. So
Oh, okay.
investing in trust deeds. And I love that because it's completely passive. You don't have to do any work. You just do your due diligence up front and you don't have to do any work after that.
Okay.
It's basically mailbox money.
Yes.
So it's number one, it's passive. Number two, it's you have very low risk because your investment is secured by real property. So there is an underlying asset that protects your investment. And I typically like to go somewhere at 60% LTV, maybe 65
Oh,
at the
so you
most.
have enough. Yeah, you have
So
enough
there
leverage.
is a plenty of equity protecting you. And then number three, you have nice returns. I mean, typically you get double-digit return in private lending, and I'm pretty satisfied with you know, if I get 10%
Right.
return on my money and it's
Why not?
guaranteed, I'm pretty satisfied with
And
that.
especially if you only do the work upfront, you're performing the due diligence. But whereas when I'm landlording, it's like every week, every month I got
Continuous,
to,
yeah,
yes. So,
continuous. So
yeah.
I did that, and it works great because, like I said, I use my retirement account to invest. I put as much as I can every year in terms of contributions. And the solo 401k allows you to do that. You can
Yes.
put up to $57,000
57,000. Yes.
a
This
year.
year.
So it's a great tax sheltering vehicle, which you can then direct towards alternative investments. So private lending been working great
Yes.
for a retirement account, but personally, what I started noticing over the years is as I invested more and shifted my portfolio from rentals towards passive investing or private lending, every year my interest income goes up, so are my taxes going up because
Yes.
there is no write-offs, there is no depreciation deduction.
Right.
So, and I thought, well, listen, I got to do something. I want to get back into physical real estate, but I didn't want to deal with the just single family, and I didn't want to deal with the management aspect of that. So I ended up investing in syndication. So for the last couple of years, I've been also transitioning portion of my portfolio personal, not my
Right.
retirement funds, but personal into syndication,
Yeah,
and that
because you
works
you
great.
get the benefits of scaling up. You get the passive aspect as well as you get cost segregation, large depreciation to reduce your taxes. Right,
Exactly.
and that's what I do too. I syndicate myself as well as I invest in syndications passively.
Yeah,
So I
the
do
tax
both actually.
savings is
Yes,
tremendous.
enormous. Yeah,
I finished my taxes just recently, and it's tremendous. I
yeah.
mean, uh,
Right.
so
So
it did really work out well for me.
So how do you, so right now you do syndication from your personal money and then, invest in as private money lender from your solo 401k. How do you evaluate the asset, market, and team?
Well, like I said, the two investments that I'm mainly doing right now is private lending and syndication. So, when I invest in private lending, it's, not so much the market. I work with a couple of brokers who they doing all the underwriting. So I basically, the deals are presented to me. And like I said, I usually go at around 60% LTV. I've done some of the deals in California, which is a riskier market, but again, at 60%
Yeah, you can't go
LTV,
wrong.
Yeah,
Yeah,
it's
because we know
unlikely.
it's going to correct at some point, but I'm looking at about 25% correction. So you
Yeah,
still
so
have
it's
enough buffer.
exactly. And then, you know, out of state, I've done deals out of state as well. So it's very unlikely that it's going to have that much of a correction. So again, I mean, my brokers, they do the due diligence. They select the deals. So I kind of go by their criteria.
Okay.
And then I just look at that particular investment. You know, would I want to, because the downside of being a private lender is that if the borrower stops making payments, you're going to have to foreclose and take the
Yeah.
property back.
And you have to
So
take over. Yeah.
yeah, would I be willing to own that property if things go
Right.
bad? Actually happened to me once, and
Oh,
we'll
you
go into
did.
that maybe a
Can
little
we
bit later.
talk about it? What exactly happened and how it ended?
Well, so basically, you know, I think you wanted to talk about one of the bad deals that went
Yes,
for me.
exactly. And this
So
would be
so
the worst deal.
so I guess you know, that can in a way can be categorized that way, because that was I think my very first private loan that I did. Somebody introduced me to this company, and I basically trusted the person that made that introduction. So I didn't do much due diligence on this other company, and they ended up not being the best, to say the least. So it was a company with portfolio of properties, and I landed on one of their deals, and they ended up mismanaging their portfolio, and I think they were paying. So here are the details. I lent $38,000 on that property. It was a first mortgage
Okay.
at 9% interest, and I was getting $350 a month in interest. They were paying for about 3 years, and then they started falling behind. You know, paying later and later, and eventually they stopped making payments. And now the good thing is that I didn't have to go through the foreclosure process. I talked to them, and we agreed to do a deed in lieu of foreclosure. So instead of me foreclosing on the property, they signed the deed over to me. So now I
Right.
do own the property. The property is worth about $60,000.
Mm.
My investment was 38. Okay, so it's worth about 60,000, and I have a tenant who's paying 675.
Okay.
My
Yeah,
my
that's not
interest
bad.
payment was 350. So as you
Right.
can see, my worst case scenario. Now it was a stressful time at the time,
Yes.
because I never have gone through this before, and you know, lots of unknown, but it ended up being very good. So I end up actually making money. So with private lending, if you do your due diligence up front, it actually might be, the end result might be pretty good.
That's great. So can you talk about your best deal so far?
I kind of mentioned that. I don't know if I can select one specific deal, but maybe generalize. And again, I did invest my first two properties, my residence and my first rental. Like I said, they almost tripled in value. So that was pretty good deal
Yeah, but the
for me.
residence you don't count as investment. So actual investment property is what? Because residence is a liability. You need a roof to live. Yeah.
Yes, yeah. Well,
It
it was my very first purchase, real
right.
estate
Yes.
purchase, and I ended up actually moving and converting that to rental. So
Yeah,
it
of
was
course.
both residence, and then later it was a rental. So that was good, and also, like I said, doing the syndication deals, investing in syndication deals, because of my looking at the last few years of my tax return, I've been paying a lot in taxes,
Yes.
and there is not much deductions because, like I said, I liquidated most of my real estate portfolio, was doing private lending mainly, no deductions for that.
No,
So
yeah, you
just
got to
doing,
pay the standard
yeah, I
tax.
started investing in syndications 2 years ago, but the last year, 2019, was the full year when I had several syndications for the entire year, and I received the K1. I actually received income, but on the paper there was
Right. It's the
significant
paper
losses.
loss because of cost segregation
Yeah,
or bonus
significant
depreciation.
losses. So
Yep.
I mean, those were also great.
So
Uh,
do you file tax as real estate professional to take advantage of all those passive losses? You just carry over?
I don't. I do have passive income. So
Okay,
I was
that
able
makes
to,
sense.
my CPA was able to use the passive losses to
That's
offset my
great.
passive
Yeah,
income.
that's great. Any lessons learned from your investment career? Because now I can tell you moved from single family to fourplexes out of state, then to private money lending and syndications. What have you learned so far?
Yeah, so I think the biggest lesson I learned is when I first started investing, and like I said, going back to those first two properties that almost tripled in value, more than double for sure. So I ended up taking the equity out from those properties and then started buying more properties using that. And I had some maybe not exactly correct understanding, and the teaching that I was receiving is that real estate will always continue to appreciate using a 7% appreciation as
Yeah.
an average. I learned that that's not the case.
No.
So I think I was greedy, and looking at the first two properties, obviously it doesn't happen all the time. It's
No.
most people will not see that, okay, and I probably will not see that in my lifetime also. But so I took that equity and I started buying more properties, and I was basically greedy. I purchased more than I should have, and I
Yes.
could not afford those properties eventually when the market changed, rents dropped, and I had a significant negative cash flow. I could not hold on to some of those properties. I ended up losing them. And so don't be greedy, and also don't look for a get rich quick schemes.
Right.
Real estate is something that works if you do it correctly, and you can build wealth slowly. Okay, you don't chase something that you can do quick.
That's a great
It might
point. This
happen.
is not don't go after speculation or get quick rich schemes,
Exactly,
right? Like
exactly,
stock market, real estate will take its time,
exactly.
but if you hold
Understand.
it for a long time, you're going to.
Yeah, understand the difference between speculation and investment. So I
Yes.
did speculate with those out-of-state properties. That was a speculation. I was buying negative cash flow properties,
Ooh.
and I was pretty much betting that they will appreciate. But guess what? 2007, 6, and 5, market changed, and those properties dropped in value, and the rents actually dropped. So that was an example of a speculation. I couldn't continue on with that strategy, ended up losing some of the properties. So again, don't be greedy, and slow building wealth slow is okay. It does work, and you can do it.
Yeah, makes sense. Hey, so let's talk about so you use solo 401k for investment, but what about and what about self-directed IRA? Because what I learned in because I am a business owner and I was trying to debate between when I was trying to get self-directed IRA, because I was converting from SEP IRA, which is self-employed IRA, right? And I kept debating, and then when I compared, I realized solo 401k is way better than self-directed IRA because I have my directly checkbook control already, and there is no UBIT or UDFI. So what do you recommend for like people who cannot do solo 401k because they don't have business, and if they are doing SDIRA or self-directed IRA, do you recommend them to invest in real estate because you will always have that UDFI or UBIT issues?
Well, first of all, let's just break it down a little bit. Let's look at the basis. Self-directed IRA is a retirement account, an IRA that with the custodian that allows you to invest in
Yes.
alternative assets. Okay. Now, self-directed solo 401k designed specifically for those people who are self-employed or
Right.
own a small business. So it's not
Right.
for everyone.
Nope.
You have to qualify for this, and you have to keep your eligibility. So you
Yep.
have to keep your business or self-employment activity, which can be on the side. Okay. So if you're eligible for solo 401k, by far it's a better vehicle because number one, your contribution limits are 10 times higher.
Right.
And it's exempt from UBIT tax on leveraged real estate. You can borrow from it. You can take a loan. You can, there is a Roth component that allows you to invest tax-free using the Roth sub-account.
Yep.
But if you're not eligible for solo 401k, that's simply not an option for you. So, and some people kind of get confused on this. So let me help you and your listeners maybe get a better perspective on this. If you do have an IRA, a conventional IRA at Fidelity or a Schwab or elsewhere, you gotta ask yourself a question. Do you want to continue to invest in the stock market and be subject to the risk and the uncertainty? I mean, you've seen, going back to 2007, because
Right.
my background is in financial services, and I dealt with retirement accounts. I've seen some of my clients losing half of their portfolio.
Right. So, Dmitry, my listeners are aware of self-directed IRA and solo 401k, right? My question is, why would someone do self-directed IRA, or would someone have self-directed IRA and would they invest in real estate because of UBIT and UDFI? Should they?
Yeah, well, I was getting to that point.
Again, so they are already aware of the IRA and moving money through self-directed IRA. So that's
So the point is that if you have an IRA, you have to ask yourself: do you want to stay in the stock market or do you want to invest in alternative assets? Self-directed IRA allows you to invest in alternative assets. You can buy a rental property, you can buy into a syndication, you can do private lending. Now, yes, there is a UBIT implications on leveraged real estate, but you got to look at the bottom line. Will you do better investing in real estate even after paying UBIT?
No, but then aren't you putting, and sorry to interrupt, aren't you putting your asset, a tax preferred investment into a tax, savings, basically a tax deferred account, right? So you're already losing that option. Like you are able to write off the passive loss from syndication. You can't, if you invest using self-directed IRA, you cannot take advantage of that because I can't write off. It's already in my tax deferred account. And then second, if I have UBIT, basically I have lose-lose situation.
Not exactly, Alpesh. I think what you're trying to compare is apples to oranges. You're trying to compare if you have $100,000 in your savings account and you invest in syndication, what will be the result for you? You're trying to compare that with investing in an IRA, but that's not the case. The proper comparison, apple to apple comparison is this. You have $100,000 in an IRA at Schwab, and you can invest in the stock market. Well, if you continue to do that, there is uncertainty. You can lose. Go back to the beginning of the year.
No, what I'm trying to get to is the UBIT and UDFI issue. My question is, should someone invest in real estate or should they do private money lending like you are? Because then you don't have UBIT and UDFI issue, right?
Well, for me personally, I prefer private lending. That's mainly what I do.
Yeah, and that's what I prefer too for my 401k.
That's mainly what I do.
Because I learned over the years that I'm losing the benefit of tax deferred account and that UBIT or UDFI. But yeah, so that's where I was trying to get to when you compare investments just in SDIRA, right? Is real estate, like owning leveraged real estate, is better, or private money lending is a better solution?
Well, Alpesh, again, I don't think there is a one single answer, that the blanket answer that will cover everybody. Okay, for me that's the case. Okay, I prefer that because I don't want to be involved. Okay, now for somebody else who's experienced with rental properties and they in the market where they can buy and they can have 20+% return, even even after paying if they use a leverage and they pay UBIT tax on that, after applying all of that, if their net result is 20%, it's still better than 5, 6, 7%
I
that they
see.
can get in the stock market. So that's still better.
I see.
So you have to look at the case by case
Yeah,
scenario.
I think so. Yeah, the listeners and everyone, including me, do thorough due diligence and compare and figure out if that makes sense. So let's take a quick break, Dmitry, and after the break, we'll go through fire round.
Okay, sounds good.
Welcome back to Wealth Matters Podcast. Dmitry, are you ready for fire round?
I sure am.
Okay, let's go. Would you be changing any business or investment strategy after coronavirus?
For the most part, no. It did not affect my strategy or my overall because, again, of alternative investments, I had very little change, so probably not.
Favorite real estate or finance or any other related book?
A couple of books that I can mention. Number one is Cash Flow Quadrant by Robert Kiyosaki. Yeah. This is a great book that really changed my life.
That's what
and my
changed my mind.
So that's for the investment and just overall financial book. And then book number two is Business by the Book by Larry Burkett.
Oh, okay.
So what he does is, I'm a believer, I'm a Christian, and Bible is my book of instructions for life in general. Bible has a lot of wisdom about investing. I use Proverbs a lot, but this book specifically focuses on the business, how to run your business from that perspective.
Any tool or website you recommend?
The just very quick tool that I will recommend is that I'm personally using for personal and business is I think it's called a quick scanner or a fast scanner. Basically, it's an app on my phone that scans documents, and I mainly use it to scan the receipts. So this way I don't have to.
Right. Yeah. When we travel, that's the best. Yeah.
Yeah.
Okay.
Very useful.
How do you give back?
Number one, I give back to my church, but also I support a number of other nonprofits. A few examples is we support few children in the third world countries by providing monthly support for them. Also give back to the ministry that works with the inmates, helping them get back to, and also there is another ministry that we support that basically works protecting unborn children.
That's great. How can my listeners reach out to you?
Well, the best way to connect with me will be our website, sensefinancial.com. You can also find me on Facebook, on LinkedIn, and on Bigger Pockets.
Awesome. Thank you so much, Dmitry. I had fun.
Alpesh, thanks for having me. It was great chatting with you.
Absolutely.